All right, Mike, we're going to get started. Welcome, everybody. Couple things as we get started here. We are recording today's session, so you'll be able to go back and get the information off of this session later on down the road. Give us a couple days. It'll be put up on the FCA website. Also, questions that you have today, just go ahead and type them in the chat. Myself in the office will be looking at those questions. We'll make sure that we touch on all of those questions before we let Mike go today, because we know this is a topic that is interest of a lot of people and has been for quite a while. So the educational series today is on withdrawal liability and what contractors need to know. So we've got Mr. Mike McNally here today from Fox Rothschild, and Mike's been involved with the FCA for quite a while, and then he made a change a few years back. But he's still well known for all of his work on the fund side of things. Mike actually spent a lot of years with the IUPAT International Fund and still works with contractors when it comes to those issues. So I've had the fortunate opportunity to work with Mike for quite a while now. And Mike, we appreciate you being here today to talk about this wonderful subject that always keeps on giving.
Yeah. So thank you, Tony. Again, my name is Mike McNally. Too much of my practice is withdrawal liability. So what we'd like to do today with you all is give you sort of like a basic or better understanding of withdrawal liability, what it means, and I think at least with some knowledge here, perhaps it'll put some, concerns aside. So we're going to kind of try and get this through here and start at the beginning. So I will use from time to time perhaps the word triggering event, which is synonymous with a withdrawal. So if I use that and you're saying, what is he talking about? So triggering event is an event of withdrawal or where a withdrawal liability issue can arise. So what is withdrawal liability? So there's a federal statute that created it in about 1980 or so, and kind of Congress's intent at that time was to protect retirees, and all of the law is kind of designed around that. So all of the frustrations that employers, contractors may have, you can kind of direct them towards Congress. This is not, it's not something that was, necessarily designed to protect businesses or business owners. It's designed to protect retirees. So we'll talk about first here. So there's a complete withdrawal. And so these are the kind of legal definitions of this. Um, when you were to, for example, if you were to bargain out of a pension plan, that would be a permanent and total cessation of an obligation to contribute. Why would you do that? You wouldn't. But some employers do or have. UPS, when they decided that they no longer wanted to participate in certain Teamsters pension plans, bargained out of that obligation. Another event of a complete withdrawal is a cessation of covered operations, and that means basically, shutting the doors down. So in the construction industry, there are certain unique rules when the liability is calculated. So an employer closes their doors, the pension plan will determine your liability. And it is somewhat complicated formula, but sort of the best metaphor I've found for it is it's essentially like a bar tab. And you have on your bar tab 20 years worth of drinks that you've ordered, and unbeknownst to you, the amount that you paid the bartender each time for the drinks did not fully pay for the benefits that were earned by the employees, or rather, the liabilities that were created aren't fully funded. So you got a 20-year bar tab, and then each year there's a pool calculated. And what that means is in that year, the planned actuary determines we have this much in liabilities associated with these liability with the benefits earned by the participants, and we have this much in dollars and assets contributed, and how much are we either over or underfunded for that year, and that creates a pool. Um, there are these amortizations that occur each pool year, so it gets kind of wonky. But construction industry has got some unique rules for it. We'll talk some more about the exemption. Just want to kind of give you a little bit of a backdrop about how this math works. So this is an example of what that bar tab looks like. So as you'll see on your screen, there are 20 years of contributions. This is
Mike, I'm still seeing the first slide.
uh-oh,
Is it moving for you?
moving for me. Yeah. How about
All right, I think we have a living, there we go, right there. There we
okay.
go.
Um, so you
Mike,
got
before you go on to this, I just got
sure.
a couple of things for you. Can you briefly talk about, as we're talking about withdrawal liability, I've had a lot of conversations where I'll hear contractors say, well, we're 100% funded, so I don't have any unfunded liability, so automatically I don't have any withdrawal liability. Can you talk about that? And then the follow-up question on that is a lot of contractors, whether it's the international plan or whether it's our local plans, how can they get their amount of the current unfunded liability in case and find out if they will have a withdrawal liability if they are looking to close up or do something different?
Sure. Um, Taking the last question first, you can contact the pension fund and request a withdrawal liability estimate. The national, along with perhaps many of the locals, will charge you for that. I don't think it's a relatively nominal amount. I think it's less than $1,000, but something, contractors get, and it shouldn't there shouldn't be any reason that would deter you from getting it. Um, on PPA funded percentage, right? So my plan is 117% funded. Of course, it doesn't have any unfunded vested benefits. There's um, PPA funded percentage and withdrawal liability are like apples and crescent wrenches. They have nothing to do with each other. So you might, again, back to the bar tab metaphor, a plan is 117% funded today, but 18 years ago, it was 50% funded. So again, in those more historical years, looking back to 20 years, there may be unfunded vested benefits in those years that you were allocated. Another thing to think about is there are these different actuarial methods, different discount rates used to value liabilities. So when a plan can be 117% funded, and if it uses a certain actuarial method, a discount rate other than the funding rate, it will still have tons and tons in withdrawal liability. The national plan does not use that method or those methods. Other local plans may, but it is a misnomer to think my plan is 100% funded. It doesn't have any withdrawal liability. It's oftentimes not the case.
And then, Mike, I know every situation, every plan is going to be different, but if a plan was over 100% funded for 5 years, 10 years, 20 years, is there just some kind of idea of, well, you're probably safe if that plan has been funded um, without, have no unfunded for the last 10 years? Or is that just a crazy question?
Um, so again, like 117% funded doesn't mean it has no withdrawal liability. Plans can do something called a fresh start, right, where they can kind of wipe away that bar tab. Um,
So
sometimes,
even no time length of
no,
117% funded could mean that you don't
no,
have uh, withdrawal unfunded liability. Then, correct?
correct. Yep.
Okay, that's what I guess I should have asked it that way. Thank you.
Yep. So so this is a complete withdrawal. This is what a calculation look like. It's a worksheet, it's an Excel doc, numbers are popped in, it spits out a number. There's a lot of math that's obviously going on in these cells, but this is sort of illustrative of what your calculation could look like. Um, I'll just mention this briefly, just for at least you can share this at a cocktail party if you want to sound smart. There's also something called a partial withdrawal. It's somewhat irrelevant in the construction industry. It's very rare, but there is something where an employer can decline their contribution base units to such a level that they can have a partial. I wouldn't necessarily spend too much. I'm not going to spend much time on this, but just at least for your information out there. So you got a payment of withdrawal liability, right? Assume that you get assessed withdrawal liability. There will be a payment formula that will tell you this is how much you owe, and that is calculated according to the statute. Sort of a good rule of thumb here is if you were contributing to the pension plan $100 a year, and when you withdraw, you owe X in liability, your annual payments will be roughly $100 a year. It's calculated according to this formula that we have here. There's a 20-year cap on the payments. Doesn't oftentimes come into play with, at least with respect to the national, but perhaps it may with certain other pension plans that you may be in. So you get $100 in withdrawal liability or 1,000, and you have to amortize that liability. Interest accrues on it. You pay that amount. You can, of course, pay a lump sum if you've got it and would like to. Sometimes they'll give you discounts if you give them the cash today. So you have a withdrawal. You get this worksheet. It's going to tell you how much you owe. We'll talk a little bit more about like if I get one of these, what should I do? But so this is some of the basics here. So how is this calculated? Again, like another sort of a bad metaphor here is a plan has unfunded vested benefits. It is allocated across the employers who contribute to the plan and is roughly proportionate to the amount of dollars that each employer contributed to the plan. So if Tony and I throw in and we're going to get a pizza and Tony puts in $10 and I put in 5, he's going to get 2x the number of slices that I got. So again, if you're a very large employer, your liability will be proportionately greater than somebody who is very small. So we got bad metaphors, we got a bar tab, and we got a pizza. But this is, again, the number of pizzas you're going to get, slices you're going to get, or the amount of liability you're going to have is roughly proportionate to the amount of dollars that you've put into the pension plan. So this is a question we always get. Why is this plan underfunded? What's going on here? Who mismanaged this? I think it's often the case that everybody says the union mismanaged this. They have gold-plated toilet paper at the union fund office. This is unfair. I didn't do anything wrong. And not, none of that is exactly true. I think, as I said in the beginning, the first sort of person or entity to whom you should direct a lot of this is Congress. This law was set up at a time when, maybe things were a little different, but there's a whole host of reasons why why multi-employer pension plans are underfunded, why they have unfunded vested benefits. I think a couple I would just hit again. Congress, there were certain tax laws and policies that weren't exactly designed to allow these plans to succeed. Plans have certain investment assumptions, right? 2008 happens and a plan was supposed to have a 7.5% return on their investments. They lost 24%. So the next year they got to make up the 24% they lost, the 7.5 they should have earned, and then the 7.5 in the next year. So these plans have obviously tremendous stress associated with the markets. Another thing is the employer bankruptcies, right? I'm an employer. I put in for this pizza, or I should have put in for this pizza, and then when we go to split it up, I'm not there because I don't have any money left. Those liability allocable to me is then spread amongst the other employers in the plan. These things called reallocated pools are employers went bankrupt, employers don't owe any liability. That's then spread out amongst everybody else. Very unfair. It's the law.
Yeah, Mike, and I think it's interesting because a lot of times we hear about this withdrawal liability and it gets assessed, and then because of laws and regulations you'll be talking about pretty soon here, maybe the contractor doesn't owe it if they did absolutely the right things. Well, that's good for the contractor who is moving on and retiring, doing whatever, and doing the right things. But then it's important to know, as you're laying out here, that piece of pie then is now being distributed amongst everybody else. So it's kind of a double-edged sword about the withdrawal liability is helping the fund, but then, what did the contractor plan? And that's why it's so important in our from our perspective for contractors is to really understand how this works so we can prepare for it down the road.
Yep. I mean, to be totally sure, again, using the International Pension Fund as an example, they have, kind of done some very progressive things in terms of the plan design to better, level set the returns on investments and the benefit accruals, this V-bar. It's very progressive, so they do not have some of these antiquated plan designs that have caused many plans to, kind of look more like the Titanic. But there's a whole host of reasons why plans are underfunded. It is not because of the union or somebody mismanaging the money. It is just a structural challenge these plans often have. So we touched on this here just briefly at the beginning, but again, to just kind of hit this again, if you think about it, what a pension plan has is they have an actuary or actuaries, and this actuarial firm will say we have liabilities associated with a participant. And so when a participant vests, we know based on a mortality table how much in benefits they earned. And we have assumed they retire at normal retirement age and they're going to live till 86. We're going to have to pay them 20 years worth of payments at the benefits they earned times the benefit rate. And then they have some dollars associated in liabilities. And so what they do then is they have to present value that to determine, all right, so we have this much in liabilities, we have this much in assets. What is the delta, right? What's the unfunded vested benefits? And back to my example of the 117% funded plan, that plan, if it uses some of these different actuarial methods, it will still have very large withdrawal liability. And so the swing that can happen when you use these other actuarial methods, sometimes there's various ones, but the Siegel blend is a pretty significant one. It'll take a liability that would have otherwise been zero and can balloon to $26 million because it is tied to certain interest rates. National plan doesn't use it. I'm confident there are many local plans that do, but again, just this idea that, oh, it's 117% fund, it doesn't have any liability, it definitely can. Talked about this earlier, apples and crescent wrenches, PPA funded percentage doesn't have anything really to do with the amount of withdrawal liability. Try not to confuse the two. A plan can have its funded percentage went up. That means the liability went down. Not necessarily. It can even be the reverse. So oftentimes something you hear is it's 100% funded. It can and it does. So
And Mike, also, I guess I failed to mention too that we have, and as I'm looking at the people that are on listening to this, we have a lot of contractors who are involved in multiple funds throughout the industry in different trades with different organizations too, outside the IUPAT, with wall and ceiling and some of the other groups. This stuff all applies regardless of the fund that we're talking about, correct?
yep. So
Yeah. Okay. I just wanted to make sure that was clear so people have the right information for their other funds also. Okay.
Yeah. Yep. Each plan is, you can have a teamster, carpenter, painter, electrician. You got, various different plans. Each of them will have their own liability associated with that plan. So this is probably why a lot of people tuned in, or this is what I think a lot of folks understood, right? There's this idea that while I'm in the building construction industry, I'm a painting or a drywall or ceiling contractor, and so long as I don't go non-union, I don't know this. It's generally true. And so this is called the building and construction industry exemption. And again, think back 1980. The idea was Congress thought then that, the, union construction industry is somewhat like a closed loop, right? If I employ certain members of a union and I go out of business, all of my workers and my customers will be sort of sucked up by my other competitors in town. So there won't be any decline in the contributions that are made to the plan, right? Sort of this closed loop. It's sort of a transient workforce. I go out of business. Tony takes my customers, my workers. The pension plan hasn't seen any decline in contributions. So for that reason, in the building construction industry, we have different rules. And so a withdrawal only occurs if you cease to have an obligation of the plan to contribute, meaning you close your doors and you retire to Florida, and you don't go non-union within a 5-year period after that. So a couple parts here to break up. So the building and construction industry exemption, it means that substantially all of the employees on whose behalf you had an obligation to contribute to that plan performed work in the building and construction industry. And so this is something that's been kind of developed through case law over the years. Congress didn't necessarily define these too well. So the first part we'll talk about is substantially all. It's generally defined to mean about 85%. And it is not clear, and it's clear in my mind, but there's this sort of an issue that's litigated commonly is, well, how do you measure that? Is it 85% of my belly buttons? Is it 85% of my hours? Is it measured throughout the course of the 20-year period? Is it 3 years back? Is it 10 years? And do we measure that month by month, any given moment in time? And how am I supposed to even determine this? How would the pension fund know? Time cards are, I think, generally sort of the best sort of data, right? If I had a workforce and I had really diligent timekeeping, I could show that in these weeks, Tony worked at the Acme on Broad Street, and here's the contract that shows that we were engaged to finish the walls for the construction of the new Acme. That would be building construction industry work. And if I only had Tony as my employee, I would have more than 85% of my man hours were for work in the building construction industry. Obviously, this is, gets very nitty-gritty in terms of the data. And, just to be frank, many contractors don't have sophisticated record keeping like, Microsoft or IBM. So it's somewhat of a challenge, but, you can kind of get there through shoeboxes of time cards or, digital record keeping systems, contracts, etc. So at least 85% of the hours that you contributed to the pension fund must be for work performed in the building construction industry. Okay.
Mike, if I could, one of the explanations that we've used in the past was as if I did 100 hours to make the math simple, and as long as I have my employees that 90, in this case 85 or more, so 85% of the hours were actually done on covered work for the union that I'm signatory to on that. Then the other hours, so in this scenario, let's say that we had 86% of the hours were done in the finishing trades, okay? And then if 14 was done with my employees and I had them do landscaping work for somebody else, I would still be covered in that scenario, correct?
Yeah. So, depends. And so I think that's a good, you led me here into the next topic, I think. So what is work in the building construction industry? Right.
But let me just, but I have that 15% that can be outside of it, correct? I can have up to 15% of my hours that is totally outside of what I'm covered for. That's one of the confusions, because here's where I'm really trying to get to is if I assign this, if I do work that's not covered for more than 15%, let's say I do 16% or 70%, My withdrawal liability is then based on 100% of the hours, correct?
Yes.
That's the point that I want to make sure that people understand.
Yep. Um, so what is Burke in the building construction industry? I'm confident that everybody who's listening to this says, well, I'm a painting contractor, I'm a ceiling contractor. Of course, I'm in the building construction industry. And so this is where the details matter. So again, MEPA Congress didn't define what building construction industry means. So the way it's sort of defined is with reference to the National Labor Relations Act and sort of how the National Labor Relations Board has interpreted that term. On your screen are some quotes I have from various decisions that we use or think about. Um, Essentially, I think it boils down to you know one is work in a shop, right? So you have a sign shop and you're building signs, or you have a shop where you're building materials, a production facility. That's not building construction industry work. Work on a job site where there's boots on the ground, that's building construction industry work. And then sort of the next level to that is, are they building something on the site? Are they repairing something on the site? Are they altering something on the site? And I think um, from my perspective, you think about painting. Um, we have the new Acme on Broad Street that grows up, and the sheetrock guy finishes, and the painter comes in and he paints the wall. That's building construction industry work. Alternatively, we have a new office tenant fit out where we're going to blow out the walls and redo the carpet and replace some electric and put in some new lights, and we want to refinish the walls. Where there's trades working together on a site, that tends to, fall more along the lines of building construction industry work. And sort of then from there is, what I might call like repaint. Um, the new tenant comes into the office space and they don't want to change the lighting or the flooring or move the walls, but the walls just need a fresh coat of paint, right? Is that building construction industry work? Is that an alteration? Is that a repair? Um, and I think that's a little bit of an undecided question here. So I think there are good arguments that you're repairing the structure, right? You're finishing the walls or the smudges. I think there's other arguments that it's really not.
And so my Congress has kind of left this broad definition, which then in one sense is really good because it allows the funds to be able to kind of define and within the parameters that Congress did lay out. And then so it could be different from fund to fund. Not, I mean, it's generally different work, so it's maybe it's not different. But the point is that each fund can look at it a certain way, and that's why there's trustees, both labor and management on it. I think you brought up a great point that my landscaping thing was an example that I guess it falls in with your beer and your pizza, or the bar and the pizza. But you brought up the shop work, and in its simplest form, if I'm a glass man, if I'm a glazing contractor or even a coatings contractor, if I'm manufacturing or doing things in my shop, and let's say out of my X amount of hours, that 40% of the hours that I generate in my organization, my company, is being done in that shop, and only 60%. That doesn't meet the 85% rule. So in that case, I would, at its simplest form, I would probably have withdrawal liability, correct?
Yeah, you would not satisfy the exemption, correct?
Yeah. Okay. All right.
Um, and I think to something you said, like the pension fund doesn't know, right? How would the pension fund know what work your employees have performed? They don't follow you around. They don't know. And they got a 0 hours report or they ceased getting reports from you and they call the local, business manager and they said, what happened to Tony's painting? We haven't got any. Oh, Tony's painting closed. Okay. Can you tell me anything about what they did? Painting contractor. What do you want me to tell you? So they don't know. And it's no fault of their own. And so they will perhaps do some investigation to the extent they can and do some calling around, but they'll more often than not say, we determined that you withdrew from the pension fund. And it is then essentially on the employer to say, no, 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 I did not, because more than 85% of the man hours that I contributed to you, pension fund, were for building and construction industry work. And here's the data I have to substantiate that. So pension fund doesn't know. Law basically gives them, allows them sort of the burden, or puts on the employer the burden to say, you're wrong. And pension plans have different rules, different methods of investigating this. You get this assessment, you say, I dispute this. I did not, or more than 85% of my man hours were for sort of job site work. Here's this data, and I'm going to prove this. And you have to do what's called a request for review. You write them a letter, you send them, all these documents and analysis that you might have. Here's why I satisfy this exemption.
Yeah, and I think a big point in talking to like the administrators with some of these funds and everything, they're all, and this is I think is a very important point today. They're all open to talking to you about this. It doesn't affect you at all right now to go talk to them about it with the union. I know sometimes we look and say, well, I don't want them to know that I'm thinking about it. It doesn't hurt you as long as you're not planning on going tomorrow and you have no plan in place. The idea is with this information too, is that this may be one of the biggest issues that you need to have a plan for as you go down the road, depending on what your succession plan is going to be. So whether you reach out to us or you go directly to the union, it's very important because there are ways to do this properly as long as you plan for it, where you can really kind of reduce or eliminate things that probably shouldn't have happened to you. Last thing you want, and we've had this happen, is to close down your doors, sell off your assets, and then get an 800 or million or whatever dollar bill from the pension that you have to start paying in, what is it, like 60 or 90 days that you have to start paying it while you litigate this. So, and that's kind of the whole purpose of this information, is to get everybody to kind of plan moving forward.
Yep. So applying this, what is building construction industry work? I picked a couple cases, dozens out there. I thought at least some of these were, I think the first one is for sure relevant, right? So Trump Entertainment Resorts, casinos in Atlantic City went bankrupt. They closed. They had in these three hotels what were termed maintenance painters or in-house painters. And these fellas essentially walked around and with whites on and a bucket. And if I smudged the wall or the handrail, they'd go around and make sure it looked very nice. And they were there 365. There was no sort of change of workforce. These same 9 to 12 guys were there week in, week out. That is not building construction industry work, right? That is, very clearly, I think, maintenance painting. It is not, they're not making a new structure. Are they repairing something? Maybe not really. The arbitrator didn't believe it. So Trump Entertainment Resorts, not a building construction industry employer with respect to those maintenance painters who just walked around all day and fixed the smudges. Another one here, the cable guys who came out to install your new internet system or your wireless, where they would grab a line from the exterior of a residential or multifamily sort of unit and would run the cable and might poke a hole through your wall and tack on a couple things to your wall that ran the cable. That is also not building construction industry work. I don't know that that necessarily shocks anyone, but your cable guy is not performing building construction industry work. Sort of a recent one here, asbestos abatement, right? The guys who go in with the super duper PPE, a pension plan alleged that this employer did not satisfy the exemption because the removal of asbestos is not improving a structure. This thing got litigated all the way up to a circuit court, and the court said it involves the structural alteration repairs. So I know we don't necessarily have any asbestos guys on the line, but this is asbestos removal is building construction issue work. Dozens and dozens of cases out there on this. I think this sort of just kind of illustrates to you sort of how detailed this analysis can be. Um, so if I do satisfy the exemption, I don't have any withdrawal liability. I'm off the hook. I don't have to pay that bar tab. Um, if you don't, um, you do. We'll talk about some other limitations that might apply. But even if you do satisfy the exemption, a couple things just to keep in mind here, these are like the very negative surprises. I say to the painters union, I've done my painting work. I'm done. I'm just going to do carpenter's work or electrician's work or whatever. I'm not going to do any more painting work. But then within that 5-year period, I pick up a scope of work on a contract and I employ a non-union painter or subcontract that work non-union. That's going to be a triggering event. If you, again, negative surprises here, the one union comes to you and says, hey, we can do the same scope of work that you're employing this other trade to perform, and we'd like you to use our members instead of theirs to do it, right? So you've withdrawn from that pension fund and now you're contributing to this other one. So you assign work to another trade and you discontinue the old one. You've got an event of withdrawal. We talked about the subcontracting after abrogation. This is a really unfortunate one. A union disclaimer of interest. A union could say, we don't want anything to do with you anymore, employer. You are a pain in our ass. And that is also an event of withdrawal, right? Because you've ceased to contribute involuntarily, but you've ceased to contribute. Again, you bargain out of the obligation to contribute to the plan. Easy one. Don't do that. And the last one here is like where the members say, we don't want you to be our bargaining representative anymore, union. You've involuntarily withdrawn. This happens, very unfortunate, but just some ones to kind of keep in mind out there. So building construction industry exemption, very detailed, trying to kind of give you the basics here in a lunch and learn. Assuming that you're sitting there thinking about this and saying, I'm not really sure, I don't know, I don't necessarily have 20 years of time cards in front of me or whatever time period I need to have, I don't really know. Or maybe you're thinking to yourself, I don't satisfy this and I'm kind of nervous here. What can I do? Can't change the past, but you can think about what's going to happen. Assuming the worst case happens and this liability is going to be incurred, what do I do? So the pension plan can't get blood from a stone. So I close up my painting business and they say, Mike, you owe $1 million. And I say, good story. I have, $5,000 in the bank. Not many, not many contractors keep millions of dollars in their, operating accounts, of course. So who's liable for this? It's the employer that is liable, and an employer is defined under the law to mean all trades or businesses under common control. And so think about like a shooting gallery here, bad metaphor, but the first person the pension plan is going to put in the shooting gallery is Mike's painting. And they're going to say, Mike's painting's on the line here for this $1 million. And we say, Mike's painting doesn't have $1 million. It's got 50 grand. I'm going to say, well, what else do you own, Mike? Do you, Mike, personally have an interest in any other businesses, any other trades or businesses that you own? Could be totally unrelated. The tanning salon, the ice cream shop, real property. Do you own the building where Mike's painting operated out of? So these are all trades or business under common control. So if you're thinking about this and saying, I'm going to owe this liability, what can I do to think about limiting the entities from whom the pension plan can collect? Something you need to think about is what else do I have an ownership interest in? And if it's nothing, then that's the end of the story. But if you own the real property, most commonly we see where there's a real estate holding co that I also own, or sometimes you see these sort of harebrained schemes where somebody said, well, my accountant told me to put it in my wife's name. What your wife owns and what you own are attributed to each other. So any other businesses that you own can be liable for this. So this is called a control group. It's a strict numerical test. Easiest example is I own 100% of Mike's Painting. I own 100% of Mike's Real Estate Holding Co., Trader Business Under Control, jointly and severally liable. So Mike's Painting's got 50 grand. Pension plan wants $1 million. They're going to go get it from Mike's Real Estate Holding Co. Your spouse, what you own, she is deemed to own. So if she owns something unrelated, she's a realtor and she owns her real estate company. That thing is also on the line too. So think about what other businesses you own. Just a couple of the ones that and just to kind of put a test, like a little bit on this. A trader business is whether or not it's incorporated. So again, back to Mike's Painting. Mike owned a painting company, which is an LLC. Mike then personally owns as a sole proprietorship the real estate that it's on. Mike, in his personal capacity, is engaged in a trader business. This real estate that I own personally is now going to be jointly and severally liable, and then I am too, because I own this as a sole proprietorship. So I won't get into, people have investment companies and stuff, and there's some other little nuances around that, but think about any other businesses you own. So the surprises we see here are unrelated business. I have a painting company and I have a dog grooming salon. It's unrelated to the painting company. It doesn't have anything to do with it. Doesn't matter. If it's commonly owned, that's the end all be all of the analysis. The building and the real estate, we talked about that. The vacation properties, right? I got the Airbnb or the VRBO or the beach house that I rent out for a few weeks in the summertime. That's also a trader business. Even if it's not incorporated, if I have something that I do for profit, it is going to be liable. So trust and estates, sometimes depending on what they do, if they lend money, that's a common one that we see. They own real property, that's another one. Couple cases here we wanted to talk about. Again, these are just the nightmare scenarios. The employer owns the real estate company. We talked about that. Another one here, the vacation rental home, right? I got an Airbnb, I got a VRBO, I rent out my shore house. That is also going to be subject to the liability. Family trust, right, that owned and leased the land to the contributing employer. It was engaged in a trader business. So again, I think you can kind of take from this that the law was not designed to protect employers. The law was designed to protect retirees, and it gives pension plans sort of a whole host of entities and persons that they can pull into that shooting gallery. So, a couple other points we wanted to kind of hit on here as we close out time. So, when you know, many employers, many contractors, right, work on a line of credit with a bank. Some have the ability to sort of self-finance their business, and they will make loans to the business. And if I had a $500,000 loan to Mike's Painting, and then the pension plan comes in and says, Mike, you owe us $1 million. I say it's got 50 in the bank, and I'm owed $500,000. So I get that money back first. They'll want to look at, is it a capital contribution? Is it a loan? And the difference is important. And a loan looks like what a loan should. It's in writing, it's got terms, it's got interest, versus a capital contribution is I just move my money from my personal bank account to the business bank account, online, and that was that. So when you make loans to your business, make sure you're documenting that. It's really important. If the bad scenario happens, you want to be sure that that money is going to be paid back to you. We often see this as a business is sort of winding down here. The shareholders want to get paid back what they put in. When that liability comes, The pension plan is going to want your financials. I said, why did Mike get paid out all this money 6 months before you guys closed up? And they're going to want to try and claw that money back. Limiting liability, right? So assuming that you don't pass the building construction industry exemption, and the only thing that you own is Mike's painting, the pension plan says you owe $1 million. I say, I don't have $1 million. I have $100,000 in the bank, but you don't want to give the pension plan $100,000, or I wouldn't. There's certain provisions in the law that sort of allow you as an employer to walk away with, not all the money, but a little bit more than a shirt on your back. Commonly, we use this thing. It's called 4225A. It limits the liability to 30% of the liquidation or dissolution value. So Mike's painting owes $1 million to the pension fund. It's got $100,000 in the bank. After collecting all the receivables, paying out all the payables, we got $100,000 left. The pension plan gets 30 cents in the dollar. I get the other 70. So you don't have to pay him the $100,000. The law allows you to kind of crunch down this liability. There's some other ones that limit it based upon your solvency tests, a little more complicated. Transactions, Tony talked a little about succession planning or sort of your ability to, pass this business on. If you do a stock sale, it is basically like, back to my bar tab metaphor. I'm sitting at the bar. I've got my 20-year bar tab in front of me. Tony taps me on the shoulder and says, Mike, I'd like to take your spot. I hear you're getting up. Tony sits down, and now that bar tab is his. He owns the stock associated with my business or my bar stool. A sale of assets can be an event of withdrawal. So if you're going to sell your assets, you need to understand whether the building construction industry exemption applies. There are some workarounds for this. 4204 sales are what we do when you do not satisfy the building construction industry exemption.
Well, we have a question on the stock sale. If everything's done properly, assuming everything's done properly, we sign those documents today at 4 o'clock. Am I totally 100% pass that on at 4 o'clock today? And as the seller, I am now removed from that from any aspect based on things were done properly? Is it immediate or does it take time? Is what's involved there?
So, what's assumed with a stock sale is that the business is going to continue to observe the terms of the collective bargaining agreement, meaning pay into the pension fund. So Mike owned all the shares in Mike's painting. Tony comes along and buys them, provided Tony keeps doing what I did, union contract, pay into the pension fund, no flag on the play, no liability results from that. So it is essentially just change the name on who owns the stock.
So if I sell to you and 4 months down the road and I'm done in 4 months down the road, you have some thing that you're going to solve all the world's problems and not pay these pensions, and you make those decisions after I sell. Is there any way liability come back onto me after I've cleaned my hands of it? I mean, I think we're under the understanding that no, there isn't.
No. And
Okay.
your purchase and sale agreement or whatever would, probably reflect something along the lines of seller isn't obligated for anything following the date of close. Anything that
And
precedes it is mine.
okay, and then one more here is if once that stock sales, a lot of times we have, well, Mike, we want you to work for the company as an employee for the next 5 years or 2 years or whatever. Do you have any liability doing that?
So long as you don't keep any ownership in the business, if you're just the consultant or the trusted guy we want to keep around, no.
Perfect. Okay, thank you.
So with a lot of information for you all here in a short minute, a couple things here I think you could think about is, I would thinking about the building construction industry exemption and sort of the nuances and repaint and what does that mean? And, I tried to offer you the best guidance I could. It's a little bit gray, but you should think about that. You should think about what your record keeping looks like. Do we have time cards? Do we keep those customer contracts that were somebody to say, hey, we think that you didn't perform building construction issue work. Do I have that data there that I could use to defend myself? Um, think about your control group for sure. Do you have those rental homes? Do you have another business? What are you going to do about that if, you plan for the best, but the worst happens? Get your withdrawal liability estimates. No harm in it. Shouldn't necessarily keep you up at night, but it's something you can do. Um, you know, this isn't necessarily respect to the national plan, but if you got a local plan and, we see this commonly is employer contributions start to decline. You got a union marketplace that isn't necessarily growing, it's shrinking, and the number of employers is continuing to dwindle each year. And you're perhaps like the last man on the Titanic. You don't necessarily want to be that guy. So understand what's happening. What can you do? What are there opportunities to kind of protect yourself or your business? And then, make informed decisions. Hope this was helpful. You can reach out to me anytime. I'd be happy to talk to you. But, a little bit of knowledge here. I recognize this is a topic that might keep you up at night, but hopefully with a little information, you can make some better decisions.
Yeah, Mike, and I think it's really important here as we wrap up that the idea is not to get away from putting the funds into the pension, right? We all need the pension to be healthy. At FCA, we appoint those trustees, and we have trustees that are working their tails off with labor trustees on the international fund for the painters. But then there's other people that are doing the same thing with the other pensions in the trades. This is not about a workaround on how not to pay the fund. This is about understanding, no different than understanding any other liabilities that you could have on your books with your business, and even as little as how you designate the work that's being done. Mike talked about time cards and everything. Putting the wrong designation because it was just simple for you and you never thought about, hey, my employees did this. Well, maybe they didn't really do that. Make sure that stuff is accurate, because coming back 10 years later and say, oh no, they didn't really do repaint work. They were actually, that's just the designation we use, or whatever designation. I don't want to pick on one particular side of it. So that designation that I've learned from Mike and others is important to be correct. Again, this is about having the information and following the process and doing the things so that things are done properly. It's not about skirting the plan, but it is about making sure you understand it. And the issue is we've got jobs to do all day long, and that's getting the work done out in the field and running our businesses. But it's very important that this is important, maybe even more now, 10 years out, 20 years out, 30 years out, before you're going to make a change. And we don't know what's going to happen over those next 10 or 20 or 30 years, God forbid. And we're fighting, meaning FCA and the industry is fighting almost annually to make sure the building construction exemption still makes sense. If that goes away, then none of this matters, and we're all going to owe those dollars. So that's one of those legislative things that we keep working on. Mike, as we wrap up here, I think we've answered the questions that have come in. What do you recommend to the contractors right now on this? I know we said get information, get your questions answered. But let's say I'm a contractor and I'm going, wow, this is a lot of information. I'm not even thinking about selling. I'm going to go back to my office this afternoon, tomorrow. I got a lot of work to do. It's going to kind of go to the back seat. What's the best thing to do to start preparing? And again, I know one thing is to go out and just get with your fund administrators, talk to the FCA or any other representation groups you have. But as a contractor, what would you recommend I do right away to start preparing for how I handle this?
I think the best advice would be, I'm, probably a little bit of a risk averse guy. So if I own my business and maybe I don't have the best succession planning, the first thing I can do is think about sort of how can I be sure that I have the right people in place to continue this business? And that's not just good for me, it's good for the industry, good for the pension plan. Succession planning is something that doesn't happen overnight, very important. Um, I know you all do lots of classes on sort of the benefits of that and how to do that and identify the best people, but continuity of your business is good for everybody. Um, I think a second thing I would think about is, the best laid plans don't necessarily always work out. So if that succession planning isn't necessarily going to work out, what's going to happen to me, to my business, to my assets? Maybe I've done well. I was able to invest in some real estate. I got a beach house that I rent out. You got to think about those control group entities. If things don't work out, you know, what is maybe going to be your retirement savings there in that, rental property or the dog grooming salon is now in jeopardy. So think about how I can kind of rearrange some stuff and not own businesses that can potentially move into that shooting gallery.
Yeah, I think it's just all about preparation. This is not to scare anybody, but to give information. We talked about retirement. Everybody's worried about their investments, but you should be just as worried about, in a lot of people's opinion, is your tax planning at that time in your life. In this case, yes, your business, focus on all that. This is just an aspect that sometimes gets left alone, and it could create you problems. It's part of the industry we're in, and it can be managed, and it can really be positive in all directions. We just have to take the time with it. So, Mike, I can't tell you enough. I appreciate your expertise, your time and effort, and everything on this. We'll be getting this information out to people. They'll be able to watch this video, so your information will be on that. We put information, and anybody who contacts us, and we can walk them through them, and we'll put them in contact with you and make sure they get the help they need and everything. So, Mike, I appreciate your time.
Yeah, thanks, Tony.
You bet. Take care.